Real estate calculations are essential for investors, home buyers, and professionals to assess the value, profitability, and financial feasibility of properties. Below is a list of some of the most common ways to calculate various real estate metrics. 1. Mortgage payment calculation. This calculation helps to determine the monthly mortgage payment based on the loan amount, interest rate, and loan term. Formula: M equals frac P times R times 1 plus R N, 1 plus R squared, N minus 1, where minus inc equals monthly mortgage payment equals loan principal amount borrowed, R equals monthly interest rate, annual interest rate, 12, N equals number of months, loan term in years, kix 12. 2. Loan to value LTV ratio, used to compare the amount of the loan to the appraised value or purchase price of the property. Formula: LTV frac text loan amount appraised property value. LTV is often expressed as a percentage. 3. Net operating income NOI. NOI is used to calculate a property's profitability before financing and taxes. It includes income from rent minus operating expenses. Formula: NOI equals text gross operating income text operating expenses. 4. Cap rate capitalization rate. Cap rate is used to estimate the rate of return on a real estate investment based on the NOI and the property's value. Frac net operating income NOI current property value. It is typically expressed as a percentage. 5. Cash on cash return. This measures the return on cash invested in the property. It is used by investors to calculate the annual cash return relative to the initial cash investment. Formula: cash on cash return equals frac annual pre-tax cash flow total cash invested. 6. Gross rent multiplier GRM. This is used to assess the value of an income-producing property by comparing the property's price to its annual rental income. Formula: text DRAC property price gross rental income. 7. Debt service coverage ratio DSCR. DSCR is used by lenders to evaluate the ability of an income property to cover its debt obligations. Formula: text net operating income NOI debt service. Debt service includes principal and interest payments on the mortgage. 8. Price per square foot. This is used to compare properties based on their price relative to their size. Formula: priced property price total square footage. 9. Break-even ratio BER. This calculation helps investors determine the occupancy rate needed for a property to break even. BER frac text operating expenses text debt service gross operating income. 10. Return on investment. ROI measures the profitability of an investment property relative to the cost of the investment. Formula: ROI net profit total investment times 100. Net profit includes any gains from the sale of the property minus initial investment and costs. 11. Internal rate of return IRR. IRR measures the profitability of potential investments based on expected cash flows and future value. It's more complex, as it considers the time value of money. Formula: this calculation is typically done using financial calculators or software since it involves solving for the rate that makes the net present value, NPV, equal to 0. 12. Future value of investment. Used to predict how much an investment property will be worth in the future. Formula: FV equals P times 1 plus RN, where minus P equals present value or initial investment equals interest rate or growth rate. N equals number of periods year. Number 13. Operating expense ratio OER. Used to calculate the efficiency of a property by comparing operating expenses to gross income. Formula: OER equals frac operating expenses gross operating income. It's usually expressed as a percentage. Number 14. Vacancy rate. This measures the percentage of time a property is unoccupied. Formula: text vacancy rate equals vacant units or space total units or space. 15. Gross income multiplier GIM. This is used to estimate the market value of income-generating real estate. GIM equals frac property price gross annual income. Number 16. Appreciation rate, the annual increase in the value of the property. Formula: text appreciation rate text new value original value times 100. NAR 17. Effective gross income, EGI. EGI represents the total income of a property after accounting for vacancy losses and other income. Formula, e.g. text, gross potential rent, vacancy losses, other income. These calculations cover a wide range of aspects in real estate, from assessing financing options to determining investment performance and profitability.